Hello and welcome to the latest edition of Between the Spreadsheets. I'm Stephen Englander, as usual, and with me today I have my old friend Marcus Wood. Marcus is a commercial finance wheeler dealer. He finances everything from buildings to businesses to everything, based in his London office at River Commercial. Marcus, how are you today?
Hi, Stephen. Very good, thanks. And thank you for the opportunity to discuss and the podcast. I run commercial, we're licensed finance intermediary, where we cover the whole of the UK, including Northern Ireland to a degree. Not as much of a degree as we'd like, but we're getting there with it. But we fund generally all real estate assets, from land acquisition, commercial, residential, and we work on property development as well. So we cover a broad array of real estate assets.
Yeah. Well, I know you're being a bit modest because I know that finance today is so difficult to get, especially when it's speculative finance or development finance. I mean, in fact, a couple of clients that we've dealt with together, I don't know how the hell you've got finance for them, especially at the level you've got them. So we were talking earlier that is finance a case of more who you know rather than what you know? Is it a case of presenting things right?
There's an appetite from every lender for a certain type of asset and also for a borrower. Obviously, the higher risk the profile of the borrower and the deal, the more costly it will be. It's priced accordingly. There are many lenders out there who will offer remarkable loans to people who you would never imagine would get any form of facility, but they'll pay for it accordingly. We try to sort of steer more towards the vanilla clients. Obviously, it makes our life a lot easier. And what we find with a lot of the sort of the higher risk deals, I mean, they're sort of one-offs, and they're not really a sort of there's no longevity of relationships with those clients generally. But just going back to your questions, I mean, yes, there are generally many options out there, and it is widely accepted that if you do have a relationship with somebody from the lender and you don't necessarily qualify for their current products, based on that relationship, if that particular credit risk officer knows you, there may be an option there to get a loan sanctioned. So it's not quite so regimented as a typical mortgage or a buy-to-let market, where it is more sort of done on relationship kind of basis. But yes, there are many lenders out there who offer across a wide array of clients and property deals.
Yeah. What are your favourite sort of deals?
Bridging finance, because it's very fast and it's relatively seamless, and we tend to pick up the buy-to-let remortgages thereafter. So we sort of, it's a very quick deal to get on the ladder very quickly or to the asset acquired. But then we generally have to find an exit strategy. We don't generally take on bridging finance cases unless the client has proven he's going to sell the asset or he's going to remortgage it into commercial mortgage or a buy-to-let. So we tend to pick up a second case after, basically. So, and then property development finance. I do enjoy property development finance. It's a long process. Depending on the deal itself, you've got to sort of buy the asset or the land, go through planning. It can take several months up to a couple of years, but they're really very rewarding. It's fun. It's an interesting line of finance, but it just takes a long time.
One of the things I've been concerned about, not just with property developers, but with business in general, is they take on a project that might have a funding cost of 10 million, for example, and they manage to secure 2 million or 3 million, and they use all that money up and then can't get any further extensions. To me, it's bad housekeeping at the beginning. It's like chancing your way. You think, well, I've got the first 3 million. I'll face that worry when I come to it. And so many people have the properties repossessed at the end of the 3 months where they've done all the groundwork, no pun intended, and they lose big time. Is this a strategy or is it just bad planning?
I suspect it's bad planning, Stephen, to be honest with you. One of our key requisites for clients is that they have developer experience. And we tend to see these sort of trends from inexperienced developers who will come up with a very good development appraisal, but halfway through the scheme decide, I can maybe upgrade certain elements, certain materials, which incoherently will generally obviously increase the cost, but can also cause delays, and delays, as we know, are cost overruns. So you end up ultimately with with a facility which isn't quite sufficient to cover the remaining build costs.
Yeah.
So it is common. We tend to walk away from first-time developers because that's a very typical thing we see with them. But the more seasoned sort of small and medium firms who we generally operate for would have a sort of have a development appraisal, and they will run at it. We always factor in 10% contingency cost for both labour and materials, and also for professional fees. You may need to get back out with more QSs, and the solicitors might need to be required to do for the work. So we generally, our developers usually meet their targets with a 10% contingency.
Right. Because a lot of people forget all these extra professional fees that often get added.
Yeah.
Now, I've noticed that you go a bit further than that, because you often don't look at the immediate funding needed, but perhaps a retained function and maybe more of a facility. So I think that's the more sensible approach in general. I think a lot of brokers need to look at their clients' overall needs rather than just the deal on the table now. It must make life a lot easier. So if you were giving some advice to somebody, either a bit more seasoned than a startup, but just general business people, what do the lenders actually want to see? I mean, it's very easy to say a good balance sheet, but what in general they looking for?
So for property development, first and foremost, they're looking for experience. They want to see a developer has essentially borrowed money from a bank, it's what we call senior debt, and completed and either sold or refinanced. So that's generally the first thing we look for there. So they're looking for sector experience. Now, we get approached by construction directors from Barratt's, Barclay Homes, and only for them, they've had a career working 30 to 40 years building, constructing thousands of homes across the UK. And they've gone along to various banks from Paragon or Lendinvest, and they've been declined. They lack sector experience as being a developer from the bank, and that's a very big point to cover. So we generally place those particular developers who are experienced, who know what they're doing, with lenders who accept first-time developers. Once we've got one deal done, we can move across the market. The gearings are always very key. With development, you've got to work within a loan to GDV, which is essentially a loan towards what the value of the asset will be once you finish the building. So all the houses you're building, what the end value is. And then you've got a load of cost factor as well. And most importantly, you've generally got to achieve a 20% profit on cost or greater. Now, if any of these are below the minimum threshold, it's pretty much not going to stack up. So we work with the developer to see where costs can be saved. Can we accelerate the scheme? Can we make it quicker to basically reduce the cost of interest? A lot of developers fail on every development appraisal to basically factor in lending, interest, and fees, and these are part of the cost. Everything is part of the cost essentially. It's got to be quantified and factored in.
So really, you're not just looking at finance; you look at the overall project. And I notice you mentioned loan to cost, not loan to value. Is that a new trend? It's more sensible. But
your loan to value would be relative to what you're buying the land for on day one. So if you find a piece of land for say £1 million, it's got planning permission to construct say 20 homes on there, then you would obviously go for a loan to value on day one. So you look for a land bridge of say 65% loan to value. When we look at loan to GDV, we've got to cover in the cost of the land acquisition, including all fees from legals, stamp duty, land tax, valuation fees, broker fees, lending interest, and add all that on. And then we look at the construction costs, we add all of those onto it as well. And we essentially quantified a lot in terms of property development finance and what the charge is going to be. And we divide it by what the GDV will be. And that will give us a broad idea of what the loan to GDV will be. Generally, lenders, the sort of high street banks would cap at 55% loan to GDV. Specialist lenders would go to 60, some at 65% loan to GDV. And a few of the quirky, high risk lenders would even touch 70% loan to GDV, which I think in this market is it's quite silly, if I'm honest, because we don't really know where the values are. But generally, you're looking at sort of 55 to 60% loan to GDV.
Okay. And how's the balance generally funded with people? Is it internal funds?
Usually their own, what we like to call hurt money. So what generally lenders will want.
It does hurt.
Things work better when it hurts. So it just depends. Lenders like the United Trust Bank would typically want to see at least 10% of hurt put into each deal. And some developers will buy land without planning, spend a few £1,000s attaining planning, then all of a sudden your land value has now being elevated to what we call a site residual value, the land with the benefit of the planning. And that uplift in value can actually be assigned to developers' equity contribution.
Yes.
So, so in terms of what the developers put in, once we've got all the way through, what if he's only put 10% on day one to essentially buy the land, once he's obtained planning permission, you could argue that it could be higher, 15, 20%. So
yeah. Well, we're constantly writing in revaluation reserves into developers' accounts to reflect this without creating any real profit for tax. It seems standard industry practice these days, isn't it?
Yeah.
So you obviously know your stuff. I mean, how did you get into this game? What made you turn broker?
I worked in regulated financial services from 2002, so pensions, mortgages, investments. I specialised largely in pensions, life insurance, but I worked for an investment firm. I found it rather boring, quite mundane. It wasn't particularly exciting, so I started venturing into commercial. So I met up with a lawyer back in 2009, refinanced a portfolio across Middlesex, and that was kind of the start of the commercial sort of line of career for me. And from there, I realised that actually focusing primarily on bridging finance ultimately ends up in attaining commercial mortgages or buy-to-let mortgages thereafter. Development kind of fell into play when I went to a networking event with Ashford's, a law firm in the city. And I was approached by a couple of developers who needed access to a couple of lenders. And they couldn't go directly because they essentially didn't have the FCA permissions to go there. So I essentially went through my agency. I brokered the debt for them. And that was kind of the start of my property development. So we converted, well, the clients converted a number of offices across Milton Keynes and Bedford and Luton into apartments. And then we moved into house building. And from there, reputation grew in the sort of development industry. And I've attained a number of very good clients who regularly build 4 to 5 schemes a year. So that's sort of my stable bread and butter.
So you've always been in the finance industry.
Yeah.
Very, very good. And I know at one point you were dealing in investments as well. Is that something you still do?
No, nothing investment. So I've always steered clear of regulatory investments.
Yeah.
We come across a number of real estate investment opportunities where developers are looking for essentially people to inject equity in. So just go back to your question a few minutes ago, lenders would require hurt money. So some developers, what they said, who don't have particular hurt money, will create an SPV and allow private equity or investors to buy into the company, which would essentially formulate that equity contribution. So we get a number of those schemes, but we tend to essentially more broker debt than arrange any form of sort of SPV deals.
Yeah. What about things like venture funding, venture capital? Is that something that you get involved with?
Not per se. I focus primarily on senior debt products. We do have a number of lenders who do provide both senior debt and private equity, who we work very closely with. They're essentially all based in and around London. Ironically, they won't lend in London, but they lend everywhere else in the UK. So that's about as far as we go. So in terms of what they offer, this would be 100% product for developers to buy land and to develop. So they essentially create an SPV. The lender would pump in the equity of, say, 35%, and the remaining 65% would be senior debt. So the developer technically doesn't put a penny in. The lender covers every cost, all the way from stamp duty, land tax, valuation fees, all the way through to marketing of the site and sale. And at that point, they'll walk away. Developer keeps 60%, the lender keeps 40%. So it's a relatively fair product.
That seems an amazing product. I'm surprised every developer in the country is not clamoring at your door for this.
They're pretty picky over their developers, so they will see quite a bit of experience. They will require PG, as all the developers will. They want to make sure that the developer's got sufficient equity in the background to cover anything.
Okay, still, we're setting out the terms and conditions and putting it out there. So if anybody does have some land or some property that they want to develop, or maybe want to get into this industry to develop, maybe Marcus is somebody you should be speaking to first. Here's the most popular question. I find it incredibly boring now. How's Brexit affecting you?
Interesting. How's it? It's a very large question.
It's just to make me look clever.
Yes.
Because I won't understand the answer.
It is a fairly tough year, to say the least. During the lockdown, all chartered surveyors were not allowed to enter properties. So we, apart from our deals which we had in the pipeline, which already had evaluation completed, we were sort of on hold from any new business. A lot of our commercial banks are not lending primarily on properties which derive pure commercial income. They only want to lend on residential income. So our sort of offering has dropped a little bit. That said, many of the lenders are coming back into the market.
Yeah.
Revenues, demand has obviously dropped quite a lot. We see a lot of information on the home owner mortgage market, which is doing quite well given the relaxation in stamp duty at the moment. But in terms of commercial and property development, it's been a relatively, lower demand definitely for this year. That said, June, July, August generally are pretty quiet months in this particular sector. And this week moving forward up to sort of late November is the sort of what we call the silly season where we have a good run. So we expect to see figures climbing out. Yesterday was our first back after the summer break, and we picked up 5 inquiries in one day. Today we've had 3. So it seems to be, it's generally the trend from September onwards is pretty good. So the question is, what will it be like for the year end? I suspect from looking at my MI figures, we're pretty down about 30% from typical trading. Our stabilised figures have been consistent since we incorporated in 2014, but this year 30% down. That said, some of the deals we've done have a larger loan quantum, so we expect revenues to be broadly the same. And because we've like many businesses, we've had to obviously cut off a lot of dead weight. The cost of sales and expenses has dropped, so it's not doom and gloom. It's been an interesting run, and I think we work closely with accountants such as yourselves to give us that sort of very pragmatic and sensible approach to how we should structure.
Well, we've got all the new relaxation of the planning laws. Will that help? Will that encourage more people to develop?
Yeah, I think so. We've also got an abundance of commercial space, according to a couple of unconfirmed reports. In London at the moment, to date, from the lockdown, only 17% is being occupied across the city. How long this will go on for? I speak to a lot of companies who are working on sort of Team A, Team B, Team C. Now, because they're using a rotary system, they're not going to require the full capacity of their premises. So we may see, with the relaxation in planning laws, a lot more permitted development conversion of office space back into residential. So hopefully we will see a lot more loans for conversions. It may address the housing shortage as well. There's an abundance of office space out there, and this is a bit of a head start for the homes to be built. So, it's interesting.
Yeah, so I could have a family of 4 in the office next door to my office in the same building. Yeah, maybe, you never know. I've always found the world of property development is quite exciting, and they seem to be making a difference and really affecting people's lives and businesses. And it's people like yourself in the background that people never see or never hear from that are actually making it happen. Because without people like yourself packaging them right and making sure that they're managing the funds right and making sure that they've got future, there probably wouldn't be any change anywhere. There's probably no buildings going up, no nothing. So I'll just clap you and say, well done for changing the country for the better.
I think the way I see what we should do as intermediaries, we have a duty of care to both the borrower, the developer, and the bank, but we generally hear more so to make sense of the market, because it is a relatively complex market. And our clients, as I mentioned at the start of the podcast, are typically small and medium-sized firms who've just started. As firms grow, you find that they tend to incorporate or bring in a finance team who then reach out. So the role of the broker generally is for the smaller firms to make sense of a very diverse market as such.
Yeah. And you enjoy your work.
I do, yes, certainly do.
We have purpose and we're making a difference.
Indeed. Yeah.
So I'll sign off now, and I'll say thank you very much for joining us.
Thank you.
Hopefully you'll join us again, and I've got lots of clients that I can send over to you because I like what you do. And if anybody would like to contact Marcus direct, if you've got any ideas or projects, please feel to contact direct. You'll see his details below. So thank you very much, and thank you for joining us again. I'll see you next time.